All right, this is Obaid on behalf of V Electronics, and in this video, we're going to talk about early financial innovations. All right, so this is early financial innovation. So when it comes to innovations in the financial market, okay, these started when you had unit banking in some countries. Okay, back in the days, what ended up happening was you had thousands of banks spread across the country. Okay, thousands of little units or shops. They were also called retail businesses because they operated like such. All right, so you have retail businesses, banking operated, banks operated in units. Much like retail businesses. Okay, unlike the banks that we see today, such as CIBC, RBC, what have you, where banks have branches all across the country. All right. Now, when you don't have branches, when you have small little units spread across the country, what's going to end up happening is the banks will dictate their own interest rates. Okay, they'll say, hey, listen, we're sort of like a retail business. Okay, we're near monopoly. We'll tell you how much you need to pay in terms of interest and how much you'll receive when you deposit money in the checking or savings account. Okay, as a result of which, okay, people were either forced to go somewhere else, and those people who didn't have the option to go somewhere else because obviously it would take a lot of time to deposit money and withdraw money back in those days, okay, they would stick with that bank and pay the interest rate or collect the interest rate that the banks told them to collect. All right, so that was the idea back in the days. Now, the national banks were there, okay, when these units were spread across the country. There were national banks. However, those national banks were regulated by the federal government. Okay, so the national banks and these banks were not connected. And obviously, commercial banks didn't have branches. As a result of which, what ended up happening was, okay, you had entrepreneurs back in those days who decided, okay, to lend money directly in the market. Okay, they said, hey, listen, why let these banks do the business? Okay, why deposit money in the bank for them to borrow money and then lend it to people who need them? Why not lend it directly in the market, as a result of which we'll have higher returns? Okay, why accept the interest rates offered by the banks when it comes to your savings account? So that's the reason why these entrepreneurs went ahead and started lending money directly in the market, as a result of which they earned a higher interest rate. Not to mention, they would borrow by selling bonds in the market. Okay, when they sold bonds in the market, okay, they ended up receiving money, okay, cash flow going in. Okay, as a result of which, okay, the cost of borrowing was less as well. So on one side, you have higher return, okay, and the cost of borrowing goes down on the other side, on the other hand, as a result of which, okay, they were making a lot more money than they would make by using the banks. Okay, so the profit was high, as a result of which these entrepreneurs, these small businesses, okay, started dealing with the public directly. Okay, so these were the early financial innovations. Okay, not much of a banking innovation, okay, when it comes to banks, but more of a financial innovation. Okay, that will be it for this video. On behalf of Electronics, this is Obaid. Have yourself a great day.